The majority of real estate investors who specialize in rehab value-add deals for multifamily and residential investment properties have had a hard time finding deals since the beginning of the pandemic due to record low inventory. Some of them have shifted their investment strategy from rehab to development projects, and ground-up construction has become a very popular loan program in the private lending industry. While attending the IMN Single Family Rental Conference in December 2021, I interviewed Nate Trunfio from Lima One Capital to get more insights about the recent shift of investors into development projects, the recent reduction of pricing in the market, and some of the challenges with financing construction loans on a national basis. I'm Rocky Butani, CEO of PrivateLenderLink.com, where investors and brokers can easily find direct private lending companies. If you're in the investment real estate business and want to gain insights into private mortgage lending, subscribe to our channel and get notified every time we release a new video. So in the construction space, it just seems like these days, there's the hottest product out there is built to rent.
Yep.
But there's also a lot of people just getting into construction lending in general, where they used to do fix and flip. Now they're moving into construction because there's such a demand for it.
Yeah.
How's that evolved from the lending side of
absolutely
what you guys do?
Yeah, so first off, thank you so much for having me here. Honor, good friends and a conference buddy always.
Of course.
So realistically, the new construction financing realm in private lending has just taken some time to get some legs under it and really sort of find its niche and its void. And I really am confident over the last couple of years, Lima One Capital and our peers in private lending have really started to fill that void. And then the demand for new construction is also significantly risen. And so let me break down some of your question. So first, build to rent. Huge buzzword. We can go into this pretty deep, so I'll leave the details out of it, but I mean, it's all over the residential realm or single family investor realm, but it's also heavily creeped into the commercial realm. So a lot of your multifamily investors are also heavily talking about build for rent right now. So you get a mix of both single family focused operators and multifamily focused operators talking about build to rent. To me, that's why you hear so much buzz about it. What's interesting in reality is there's actually not as many build for rent communities out there as one might think. It's actually, I heard a number, but it was a couple months old, so I'll just say it's under 1,000. If you think about that, it's not too many. So there's a lot of forward momentum and forward-looking developments that will be built and directed and rented out and leased up over the next coming years, and we're excited to finance a lot of it. So you talked then also about the development of sort of fix and flippers, and are they moving into new construction? And realistically, the reasoning why we're seeing such demand for new construction is because just supply and demand in general. Not enough supply, and investors want to deploy money and continue to invest and get good returns. And if they can't find the right deals in existing assets, why not build it ourselves? And so we've seen a lot of people, just by sheer nature of needing to continue to grow and scale, they can't acquire at the same pace of existing hard assets as they have in the past. They're starting to build. And I think there's some things we could talk about and some do's and don'ts from an operator perspective, but at the end of the day, all things on the lending side are pretty darn prudent to make sure that we're writing good loans to ensure the success of these projects, whether it's build for sale, build for rent, scattered infill, building subdivisions, and everything in between. And again, I'll go back to, I think you're seeing both single family investors and multifamily investors are attracted to this build for rent space because of just a lack of supply in both ends. And so why not build it? Why not create it? There's a lot of economies of scale if you can do it at a big enough size. And so that's just a great question, cover a lot of bases there, and can certainly go into the weeds more in any of those segments that you want.
Sure. One thing I've been really surprised about is how the pricing has come down so much on construction, where prior to, let's say, 2019, construction rates were always over 10 to 12%. Now I'm seeing interest rates for construction on par with just a purchase bridge loan or a
And you know the industry too well, man. So that's why I love being around you, because you always got an ear to the ground. You're absolutely right, man, 100%. And really, you just got to follow the money. There wasn't much money for construction lending a couple of years back. So let's dissect that for a second. Where does most of the money come from private lending nowadays? Thankfully, is Wall Street. It's why we're able to compress our rates in fix and flip and new construction, is because Wall Street's continued to see the proof of execution of our industry and wrap their arms around it and hug it really tight and want to squeeze for more and more and more. And fix and flip was the first product to see that. New construction, as I said, I think leading into this was a little bit of a laggard. And we've seen it really pick up pace over the last year and a half to 3 years because of pandemic related and other. But realistically, it's because the money is now there. Look, banks don't, not all banks, but a lot of banks don't know how to really underwrite new construction, nor do they want to. It's a lot easier to say, here's bricks and sticks, it's already built, this is what it is what it's worth now, if you're going to repair it, this is what it's worth after. But there's just different analysis that needs to go into, how do you build, what's the time frame of building, what's the true cost per square foot. It's different per model, or per region, per what grade you want to build in, and things like that. And, also, banks just didn't want to deal with what we call the fund control, the managing of sending out the draws on new construction, because it was just too new for them.
Sure.
And there weren't enough originators that quite honestly knew exactly how to facilitate it and diligently fund that part of it. So you've seen a lot of people pick up progress on that, put dedicated focus to it. Lima One, we have in-house construction management, which is a huge part in sort of value add that we bring to builders, is just helping manage that up front. Doing good deal analysis and just analysis, is it going to be a successful project? And as a result of good proof of execution, Wall Street's come in, and that's driven the pricing down across the industry, which is great. More and more lenders are now doing new construction, and just from hearing at the conference here we're at IMN West, there's a couple big name lenders that are rolling out product next year. So I think it's there's reasoning for it, and it's all just follow the money trail.
Sure.
The money wasn't in the new construction space, now it is. That allows us, lenders to get lower cost of capital. We pass it on to brokers and borrowers.
And construction financing has historically been a local lender product. It's only, hey, if I can drive to look at the project, then I'll lend in that region only. But you guys are doing it on a national scale. Are there any challenges with that, or is it pretty much like, hey, look, we can get someone to inspect it,
yep,
we're good?
Look, I'd be lying to say if it's easy. That would be a lie. It is more difficult. There's a couple of realms that become difficult. First is, let's talk about valuations. Valuing land is really hard nowadays, because in markets like, let's call it LA, who knows what an infill lot is worth in LA, because you never see one.
Sure.
Because everybody's buying property, scraping it to get it to the highest and best use, which is raw land, and then build up, or infill land to build up. So what comps would you have to tell me what the value of an infill lot is in LA? People don't know that. So that's hard. And then we're also our industry is using a lot of residential appraisers, and a lot of residential appraisers just don't have access to the other data to analyze land sales. So that's where we bring in a bunch of other technology and data solutions to sort of help analyze the land value, because it's just hard. The ARVs, the as-built values, as-complete values, are a little bit easier to pencil out. But at the same time, you're also relying on a residential appraiser to really fully imagine and see, based on the plans and drawings that you send them, what it's going to be worth. And then the other thing is, there just hasn't been enough new home product historically for quite a long time. So there aren't as many comps. And so we see a lot of builders sort of creating their own comps, and that just makes the valuation process on the early wave of those builds in a market a little bit harder just to figure out. The other thing, just very briefly, I'll touch on, because I hit it a little bit before, was just the analysis of the deal. Everybody wants to say they can build for 60, 70 bucks a square. Is that realistic? In most scenarios, it's not. Everybody says they can do it, but can you really do it? So that's where we like to think that a little bit of our competitive advantage is bring our in-house construction management, who build homes themselves and things of that nature, to help just do the right analysis. Because eventually, if somebody's just showing too low of a cost basis on what they're going to build, the numbers look great. But then when you put a more realistic cost basis on it, is the deal still profitable? And we're in the business of writing good loans that create profit for investors or long-term cash flow models. So, probably went a little deeper than you wanted there, but it's not as easy as people think. It's just another reason why it's just taken time to build momentum. And 2022 is a big year. If you look at all the stats of permits, permits on the rise, and starts, housing starts on the rise, there's a lot of good high-level macroeconomic factors that are going to create momentum, along with just more capital in the space and people that know how to lend on it. So,
nice, cool. Well, thanks for all that insight. And I guess if anyone out there needs a construction loan, check out Lima One. Reach out to Nate. and they could be a good capital source for you. So
Appreciate you having me here.
Thank you. Appreciate it. In addition to the rising costs of building materials and construction labor in 2022, investors faced another challenge, which was a catalyst for the shift to ground-up development projects, and that is low inventory. Starting in early 2021, there's been a huge demand for buildable land in urban and suburban markets throughout the country. If an investor is having a hard time finding vacant land to acquire, they may need to seek improved properties that can be torn down, but those too are in high demand. The majority of private lenders that offer ground-up construction financing will also fund the land acquisition. The typical LTV is 50% of the purchase price for unentitled vacant land and up to 65% of the purchase price for entitled vacant land. So investors will need to have a cash down payment of 35 to 50% for the purchase. If you're seeking financing for a ground-up construction project, use our website privatelenderlink.com as a resource. There's no fee to search, and all lenders have a detailed profile indicating their guidelines for ground-up construction loans. If you found the content in this video to be useful, please click the like button and be sure to check out our other videos about private mortgage lending. Thank you for watching, and see you in the next video.